Welcome back to Iron Financial. Look, if you're tuning in today for some light fluff and a quick stock pumping session, you are definitely in the wrong place. Today, we are initiating a heavy-duty, absolutely no-nonsense teardown of Tesla's Q2 2026 financial and operational update. This explainer is diving straight into what was an incredibly volatile, frankly highly complex quarter. Right now, there is a brutal, all-out tug-of-war happening out there on the street. On one side, you've got the long-term AI believers, and on the other, the margin-obsessed value investors. And let me tell you, this quarter absolutely separated the tourists from the tradesmen. We are going deep into the fine print today: revenue, margins, CapEx, and free cash flow. If you want to actually forge a stronger portfolio and cut right through the market weakness, hit that subscribe button and leave a like right now.
Exactly right. And I'll be playing the role of you, the viewer, today, because I want to know if this grand AI narrative that management is spinning is actually forged in steel or if it's just made of smoke and mirrors. Tesla is essentially asking investors to look past a ton of immediate, incredibly heavy financial pain in exchange for utopian AI future. So is this hype or is it real? Let's put this earnings report straight on the anvil and start hammering out the truth.
Okay, so let's start with the top-line numbers, because on the surface, this looks like a remarkably solid foundation. Tesla just crossed a massive threshold here: $100 billion in trailing 12-month revenue for the very first time in company history. I mean, they delivered a record 480,126 vehicles just this quarter. That is a massive 25% year-over-year growth from Q2 2025. That kind of scale, it's undeniable. Automotive revenue alone hit $20.5 billion. Think about how rare it is for any manufacturer to hit this level of pure revenue generation. It looks structurally sound, doesn't it?
Structurally sound until you start looking for the cracks in the armor. And let me tell you, those cracks are massive. Yes, they moved a ton of metal, but at what cost? Tesla's GAAP operating margin suffered a brutal plunge, all the way down to 1.4%. Let me put that in perspective for you so you really feel it. Just last year, in Q2 2025, that operating margin was 4.1%. In Q1 of this year, it was 4.2%. Now, management dropped global inventory from 27 days of supply down to just 15 days, but you have to understand the underlying mechanics of how they actually did that. They didn't do it through organic surging demand, they did it by aggressively slashing the sticker price. When you cut prices just to force volume, every vehicle rolling off that line absorbs the exact same fixed costs, but brings in significantly less cash. As a result, operating income cratered 57% year-over-year to a mere $398 million. They effectively bought that top-line growth by completely melting down their bottom line.
Section 1. The Financial Drill Down. Cracks in the Foundation. So, we are pivoting away from that top-line hype and staring dead into the gritty reality of the balance sheet. When a company hits $100 billion in revenue, but absolutely struggles to turn a meaningful operating profit on its core product, we have to deeply examine the structural integrity of the pricing model. Look closely at this margin compression. Q2 2025 GAAP gross margin sat at a healthy 17.2%. In Q1 2026, thanks to some one-time benefits, it popped up to 21.1%. But here in Q2 2026, it collapsed right back down to 16.8%. There are two main culprits hammering this down. First, severely lower average selling prices as they force that volume we just talked about. Second, the absolute evaporation of regulatory credit revenue. In Q4 2025, they pulled in $542 million in credits. In Q1 2026, $380 million. This quarter, a paltry $146 million. Regulatory credits are essentially 100% pure profit margin. When that revenue walks out the door, it brutally exposes the underlying unsubsidized profitability of the core auto manufacturing business.
Now, what really blows my mind here is the massive consensus miss. As an investor, we don't just get paid on revenue, right? We get paid on margins and free cash flow. I'm looking at the street estimates here, and the analyst consensus was projecting a gross margin of 19.5%. Tesla delivered 16.8%. That is a colossal miscalculation by the broader market. Why was Wall Street so completely blindsided by this level of margin decay?
Because Wall Street analysts often get blinded by historical credit windfalls. They modeled this quarter assuming those zero-cost regulatory credits would just magically bail out the bottom line again, and they completely failed to model the severity and the long-term structural impact of Tesla's ongoing vehicle price cuts. They missed the forest for the trees.
And look, the street misjudged Tesla's pricing power for sure, but more importantly, they wildly underestimated the massive heavy lifting phase Tesla is in right now. Look at this staggering capital expenditure spike. In Q2 2025,
CapEx was $2.39 billion. In Q1 of this year, it was $2.49 billion. But in Q2 2026, CapEx violently spiked to $5.79 billion. That is a 142% year-over-year increase. To really contextualize that number, spending $5.79 billion in a single quarter means Tesla is deploying roughly $63 million every single day. Tesla isn't just building cars anymore, folks. They are building the factory that builds the factory, and it requires an absolutely ungodly amount of raw capital to lay that kind of foundation.
And that insane CapEx spike triggered a catastrophic stress test failure on the cash flow statement. I mean, free cash flow swung from a positive $1.44 billion in Q1 directly into a negative $1.09 billion capital burn this quarter. Negative $1.1 billion. That's staggering. A mature company bringing in $100 billion in revenue shouldn't have startup-level cash burns. If you annualize a $1.1 billion quarterly burn, you have to start seriously questioning how long their cash reserves can withstand this kind of scorched earth strategy. Seriously, how can management possibly justify pouring that much cash into the furnace in a single 90-day period?
I'll tell you exactly where the cash is burning. They are systematically pouring it into 4 distinct, massively expensive furnaces. First, AI compute infrastructure, specifically bringing Cortex-2 online down in Texas. Second, retooling for the Cybercab, which literally just started pilot production. Third, they are literally building a custom semiconductor fab in Austin from the ground up to vertically integrate their chip supply. And finally, stripping out old factory lines to make way for Optimus humanoid robots. This isn't just basic maintenance CapEx to keep the lights on and paint the walls. This is aggressive, scorched earth expansion into entirely new, highly capital-intensive industries.
Okay, I hear the pessimism on the auto side, and I agree that CapEx burn is genuinely terrifying. But to be completely fair and impartial with this explainer, I have to challenge that negativity for a second by pointing to the structural integrity found in Tesla's other segments. The auto business might be facing severe headwinds, but we simply cannot ignore the massive load-bearing pillars that are currently holding up the roof: energy generation and services. Let's shift the spotlight there because honestly, this is where the real growth narrative actually holds up to some intense scrutiny.
Fair enough, I will concede that point. The energy segment is undeniably a rock-solid pillar right now. They deployed a record 13.5 gigawatt-hours of storage this quarter, largely supported by Megafactory Shanghai finally coming online and aggressively ramping up. That drove energy revenue to $3.14 billion, which is up a very solid 13% year-over-year. And 13.5 gigawatt-hours is just immense. To put that abstract number into some real-world perspective, that is enough energy to independently power millions of average homes for an entire day. For a division that has historically been treated as a bit of an afterthought compared to the flashy vehicles, it is now providing critical, high-margin structural support while the auto margins continue to compress.
And it's not just energy either. Look at services and other. This segment generated a record $4.58 billion in revenue this quarter. That is up an incredible 50% year-over-year from $3.04 billion in Q2 2025. This segment is bearing a massive amount of the load right now, delivering record profitability and a really healthy 14% gross margin. Let's be totally clear here. Without these two pillars of energy and services, the core auto business narrative would completely collapse in on itself. But before we get too comfortable with those wins, I know we need to pivot into the accounting wizardry. Because the GAAP numbers tell one story, but management really wants us to look at the non-GAAP numbers.
Exactly. Let's ruthlessly unpack the fine print here, because this is where the real digging happens. Tesla reported $1.11 billion in GAAP net income, but management is heavily emphasizing non-GAAP adjustments to make the quarter look significantly better. You have to understand how things like an unrealized gain on SpaceX equity, massive stock-based compensation, which hit over $1.15 billion by the way, and digital asset adjustments totally warp the earnings narrative. Stock-based compensation is a very real expense to shareholders via dilution, even if it's listed as a non-cash charge on the statement. And that $1.0 billion gain on the SpaceX investment? Listen, an unrealized gain is just a paper profit. It looks fantastic on a spreadsheet, but you absolutely cannot use a paper profit to pay the contractors pouring concrete for your new factory in Texas. You must separate the operational cash from the paper adjustments if you want to know what's really going on.
Section 2. AI Execution. Hype versus reality.
So this brings us to the ultimate battleground of this whole explainer. Management routinely claims Tesla is in its largest and most exciting period of investment. But as an investor, putting my hard-earned money on the line, I have to ask,
Is this whole AI and robotaxi narrative forged in steel, or is it just a massive smokescreen to distract us from that brutal 1.4% operating margin on their core vehicle business? My primary question is this: is the Cybercab actually ready to monetize right now, or is this just an incredibly expensive, cash-burning science project? We see in the report that Cybercab began pilot production at Gigafactory, Texas. Hey, that sounds absolutely great in a slick press release. But building a few prototypes is vastly different from successfully running a high-margin, scalable commercial fleet. I need to know if this is going to generate actual recurring revenue anytime soon.
To answer that fairly, we really have to look at the geographical blueprint of the rollout. We have to give management some credit for how aggressively they are moving here. In April, they launched unsupervised robotaxi rides in Texas, specifically targeting Austin, Dallas, and Houston. By July, they had already expanded that unsupervised operation into Florida, hitting major metros like Miami, Orlando, and Tampa. Going from 3 cities in one state to 6 major cities across 2 states in just 90 days, that is rapid, heavy-duty execution. They are systematically securing the testing, the local permitting, and the vital first responder training across major southern U.S. metros. The footprint is very real, and it is expanding incredibly fast.
Yes, okay, the footprint is expanding, but I have to push back hard on management's framing here. The report proudly touts that engineering test drives and employee rides have commenced on the Gigafactory Texas campus. Let's be brutally honest for a second. On-campus employee rides absolutely do not equal commercial revenue. Testing a vehicle in a highly controlled corporate environment with loyal employees who already know exactly how the systems work is a far cry from running a chaotic, consumer-facing robotaxi network in the real world. You look at competitors like Waymo actually navigating unpredictable public streets and generating real commercial revenue today, and you quickly realize Tesla's on-campus testing doesn't immediately justify a multi-trillion-dollar valuation. I'm just not buying the monetization timeline just yet.
Regardless of the immediate timeline, the capital is already being committed in a massive way. Look at the factory retooling. This brilliantly illustrates how incredibly aggressive they are being with their capital allocation right now. They are literally dismantling their legacy foundations. Over at the Fremont factory, they have fully decommissioned the Model S and Model X production lines. They ripped them straight out to install the first-generation production lines for the Optimus humanoid robot. Understand the magnitude of the risk here. They are trading a proven, premium legacy auto hardware line that has historically generated real cash for robotics, a completely unproven, totally pre-revenue product. That is a massive, incredibly bold structural pivot.
Right. And while they rip out those hardware lines, I actually do see a rare, high-margin bright spot over on the software side. Active full self-driving, or FSD, subscriptions surged to 1.48 million. That is a massive 56% year-over-year increase from just 950,000 back in Q 2025. Why did it jump so much? Well, because they strategically dropped the monthly subscription price, and when you combine that with the massive performance improvements in the V12 software architecture, it finally triggered real mass adoption. If there is one thing that can potentially save their rapidly decaying hardware margins, it is a rapidly scaling, high-margin software subscription base. This is the one piece of the AI narrative that is actually putting cold, hard cash in the register today.
And it's not just the total number of subscribers. It's the adoption density. Tesla achieved an over 55% FSD attach rate on new North American deliveries this quarter. That means more than half of all new buyers are opting for the software. This software metric is absolutely crucial. It acts as a much-needed temporary patch over the glaring holes in their hardware margin decay. Without that pure margin software revenue trickling in, that 1.4% operating margin would almost certainly be totally negative. Software is currently the critical load-bearing beam of their overall profitability.
But supporting all that software requires an absolutely ironclad backbone. Let's look at the compute infrastructure required to actually train these massive models. They have Cortex-1 running at over 90 megawatts, and they just brought Cortex-2 online at over 115 megawatts. They have literally more than doubled their on-site compute in Texas in just the first half of 2026 alone. Furthermore, they are taking on the monumental task of building their own semiconductor fab to ensure logic and memory chip supply. Building a custom logic and memory semiconductor fab is quite literally one of the most insanely expensive, complex undertakings in the modern industrial world. Just look at the historical capital expenditures of a TSMC or an NVIDIA. The sheer physical scale of this AI infrastructure requires immense, punishing, ongoing capital expenditure.
Which brings me right back to my skepticism. I'm reading management's defense right out of the report here. Tesla is in its largest and most exciting period of investment. Scaling will be non-linear. As an investor, whenever I hear a CEO use the phrase non-linear scaling, absolute alarm bells go off in my head. I have to heavily question if non-linear scaling is just a very convenient corporate jargon excuse for infinite capital burn. Is it just masking the fact that we are forced to wait for a robotaxi network that always seems to be just a few years away from generating actual bottom-line cash?
Section 3. The verdict. Forging the future or capital trap. All right, it is time to give you, the Iron Financial viewers, a definitive, actionable summary. We've looked at the $100 billion revenue scale, the utter collapse in operating margins, the terrifying negative $1.1 billion free cash flow, and the massive, unprecedented physical pivot from legacy autos to AI, robotics, and custom semiconductors. We really have to weigh the heavy reality of today against the promised blueprint of tomorrow. So here is the duel. On one side, you have the buy the dip thesis. You genuinely believe you are buying a company laying the long-term, ironclad blueprint for global robotics, AI compute, and autonomous networks, simply disguised as a legacy automaker.
And on the exact opposite side, you have the capital trap reality. You believe you're buying into a high-volatility cash furnace that just printed a massively negative free cash flow quarter, with core auto margins eroding fast and billions being poured into projects that have yet to prove real commercial viability.
So, the crucial point, and the huge question we want to leave you with today is this. Will AI and robotaxis actually generate real, recurring bottom-line cash before this capital furnace completely burns out its reserves?
That is the ultimate stress test for Tesla's structural endurance. You have the raw data, you've seen the fine print. Now it's time to forge your own portfolio strategy. Thanks for watching this explainer. Don't forget to like, subscribe to Iron Financial, and let us know in the comments below if you are buying the dip or completely avoiding the trap. We'll see you in the next one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.